My name is Jeremy. I'm going to share my screen here. So again, my name is Jeremy Miller, and I am a level 3 assessor, which means that I can work at the assessor's office, but we do this as a tax rep. So we represent income property owners is the mainstay of our business, which we'll kind of go through. But just a little bit about me, if those of you that don't know who I am, I spent some time in the military. I was a past vice president and education chair for Syria, and I've been involved in several nonprofit boards. I do own an IT software company. We do have a cybersecurity company. I'm a real estate broker, and again, I'm a level 3 assessor. So as we go through this, how do you normally do this? Do you guys ask questions during it, or do you wait till the end?
I always encourage people, if they have questions, to just unmute and ask. People often will put questions into the chat, and I monitor it, and I monitor the chat. So if I do see questions in the chat, I will make sure that those are asked.
Okay, perfect. Yeah, no, that's perfect. Free form is great for me. So anybody's got any questions during it, that's perfect. So okay. So what we have done, we've represented the most of the largest SFRs, and I'll use this term multiple times here if you guys haven't heard it. Single family residential or single family rentals is really what it is. And we represented H4R, First Key, BLT, and several other really large clients, all the way down to people that just have one rental property. And we also do some commercial. But we by far have we're the largest tax rep by volume in the state as far as appeals and things like that for single family. We have also provided some data in the past to in-state RIA to help for some lobbying efforts. We are certified level 3 assessor appraiser. The assessor appraiser is kind of confusing sometimes because we are not a fee appraiser. So we're not like the people that you'd go pay, the bank would send out to get a loan. It's a little different, but it is the term is assessor appraiser. We are tax reps. Again, we work for the taxpayer and not the county. Our job is to advocate for you, the taxpayer. So when we see discrepancies, we go in and provide the data, supporting data, and the cite the references of why we should be lowered. Let's see here. So to be a tax rep, you've got to be 18 years old, high school diploma, and you've got to go through level 1, 2, and 3. It's pretty lengthy process. It's much more time consuming than my real estate brokerage license. I would think it's probably, I cannot remember the exact number of days, but I would say it's close to a month and a half to 2 months worth of classes that we have to do through a series of processes. So let's see. We've got to comply with all the rules that are set forth by the DLGF, which is the Department of Government, Local Government and Finance. They oversee all of the tax assessors across the state. I think there's, I can't remember, 93 or 96 counties. A lot of property, a lot of people involved in the assessment side of things. There is a deadline coming up. It's 45 days after you get your bill. Now everybody gets those at different periods of time during well, a short period of time, but the deadline will be June 15th, and that should be 45 days from the last bill that went out. That people should have gotten it. So from the assessor's side, I know some of you may know this just because you've been in the industry for a little while, but what happens is they do a mass appraisal system, and that mass appraisal system goes through, and it's another word for it's an AVM, automatic valuation model, and then they go and tweak it a little bit so everything gets a value, and they want it to be congruent with everything else in the area. So the values you see typically are about the same for the same square footage and same. But that's not always how it is. And that's where these discrepancies come, and you want to go in and fix that. And we'll kind of go into that. So Indiana now now it's been this way for about 10 years now. It's a tax value in use. So it matters on how you use the property. So if you've got a property that, well, here's the definition real quick. So value in use is this of an asset in its net present value of cash flows or some other benefit which generated by the asset, right? So if it's a single family and you live there, then it's being used as your residence. Now, Indiana, if you don't file your home exemption, they don't know that. And if they don't know that, then you get taxed a different way too. So I'll show you that. So if you have a homestead on the property, you'll get taxed at a 1% cap. It means they won't go over. However, they can go over when they have a certain city ordinance or schools or these kind of things, and those get voted on to go over. But as a rule of thumb, there's a cap of it at 1%. Plus, if you have your homestead, then you will get also your homestead deduction on top of that. So let's say it was a $100,000 house, you got a homestead in deduction, so you knock off another $35,000 and so you're going to be paying taxes on the 70 or 65,000 at 1%. But you've realized, since you're in the income business of the houses, if you're not just flipping them and you're holding them, that the same house next to you that somebody lives in, their tax value or their tax payments are a lot less than yours. And that is because the non-homesteaded or the income properties are at a 2% cap, which you don't get a homestead and you're paying 2% of that. And of course, the commercial is 3%. So we'll kind of go through how that works in our second. But in general, when you do the assessment side, and again, this is Indiana piece of this, not all states are like this. The value in use is an income property. They try to value it as an income property. Well, what happens on the mass appraisal piece of this, they don't catch them that they're income properties. And so they get kind of lumped into this mix of all the houses in there. And so you're going to see even your income properties being the same value as the next door neighbor, and they should be valued a little bit differently. And so one of the ways that as a valuation is called a GRM. You see this a lot with commercial properties, but you also do this with a gross rent multiplier for rental income for a single family residential as well. And how you do this is oh, sorry, I was looking at some notes. So how you do this is, say you've got the $100,000 house that sold for $100,000 and you're bringing in $1,000 a month. You would divide that, and it would mean that your GRM on that property is 100. Okay. Now, again, commercial though does it a little differently. They do it based on the entire year's income, but single family, you do it based on the monthly income. So that would be a 100 GRM. But if you were to do this the other way and say, well, I'm getting 1,000 and I should be valued at a 120 GRM for this example, that would be worth, your value would be worth 120,000. And that's I mean, it's pretty basic, it's pretty simple, but that's kind of how you do it. The rub and the issue is when you want to go find other comps that are GRM, because you don't know exactly what everybody's getting in rent. You don't know what exactly they sold for, and you've got to pull all this together. We grab all this data and put it together for our comps and our GRM side, our sales comps and everything. We value in about 6 different models when we go in with the assessor, and we try to present the best one, most favorable to our client. Oh, so why would you file an appeal? And this one, I'd like to get some participation in the chat. So would you file an appeal for which one of these? And I'll wait until everybody answers. Would you file because your tax bill's too high? You just don't like paying taxes. I bought it at the tax sale and I don't feel it's right that I have to pay any taxes this year. My tax value is higher than the market, and my tax value is higher than the market value in use, or all the above. I'll wait to get some participation on this one. Which one would you file an appeal? That's you guys. It's your turn.
All of the above.
Which one's that, Bert?
All of the above.
You'd file for all the above. Okay. Alex says all the above. Anybody else got any ideas? Okay. Yeah. All right. Yeah, so everybody's right. It's too high. Now, right? The tax bill is too high, right? So now when you look at this, you got to realize that your tax bill is a result of the value of your property. And the value of your property is derived by its market value in use. So in this particular case, you really couldn't, you would because you feel like you should, but because your tax bill is too high, because it's based on the value of your home. If your value of your home is correct, then your tax bill is really not too high. You just kind of feel it is. You know, we all would rather not pay taxes, but I think we're all in the same boat where we're willing to pay our fair share. So that's not necessarily a good reason to do it. A lot of people do buy them at the tax sale and say, look, I paid up the taxes that were owed on it. But that's not a reason that you can file an appeal for your tax value. And by the way, when you're filing an appeal, you are filing it based on the tax value itself. And in this particular case, it's the tax value in use. And so the real answer would be the last one above, all above. My tax value is higher than the market value in use. And that's why you would do it. So I'll share these stats with you. These were done a while back. I did these for in-state to show and to do some lobbying. We did actually every county in the state. And this right here shows you that there were, at this time, I think this was, this might've been 2 years ago I did these numbers. There were 377,000 parcels with a total assessment value of this right here, big number, right? But and that really put the tax base for Indiana, and that's really why they're valuing these, is so that they can get their tax base to pay for all the stuff that we've signed up for in Indiana. But what these numbers down here represent are the single family rental population in the county as of a couple of years ago. Now this has gone up, but as you can tell, that 2% cap, we represent, and I say we as a collective here in the state, we represent a lot of tax base money. And this is why they had me do these figures, so they could go in and lobby and show that, that hey, we are a force to really be reckoned with, because we're paying a lot of money into the tax base. So you got it on that. So let's see here. So a SFR owner at a 2% cap. So let's see if we can do this together here. So if they had a tax value of 100,000 and their annual tax payments was approximately, right, it's 2% of that, so it's $2,000 or $167 a month in tax payments. Let's say if you get $1,000 in rent, you're paying 17% in property taxes monthly. I don't know if you guys knew that. Anybody is pipe up here if you knew how high of a percentage of your income is taxes on your rentals. Anybody? Bueller? Okay. Well, anyway, so you're paying property taxes plus your income taxes. So, you know, it gets pretty pricey there when you start getting in the higher tax brackets, right? So if you're already at a 35% and you're self-employed at another 15%, plus you're getting taken out 17% in property taxes, holy cow, your biggest partner is the government. So what do you want to do? If we get the tax assessed value down to 75,000, what does that really mean in your dollars? So your property annual taxes go down to $1,500. So it's $125 a month, basically. And if you get rent, now you've taken it down to 12% in property. You've saved 5% in property taxes, or 5% in your tax base. So, you know, what do I got here? Another example. So, oh yeah. So saving 25,000 in property taxes at a 2% cap is $500, right? Or a $42 a month saving for winning appeal. Okay, $42 might seem like not a lot. It might not seem like a lot, but if you look at that $42, that's a 5% increase in your income, right? Which means, well, what are we trying to do as an investor? We can increase our rental income by one of two ways: increasing rent or decreasing expenses. So by simply getting that appeal, we've already increased our value in this particular example by 5%. Does anybody else have any other ways that they've done it? Yeah, there you go. Yeah, exactly. Take an extra $500 in your pocket. That's a nice hunk of change for if you do this over 100 properties, it becomes pretty good. And we've sent America's Home for Rent. I can't tell you how much money, a lot of money. They've been very very thankful, and we have too, for their business. Same with our clients that don't have as many properties, but they simply have a ton. And if you followed anything that they've done, all their property values are, they're in the newer subdivisions, so they're well over $100,000 per property in their values. So let's go into how this works and what are the steps in filing an appeal. So you have an informal meeting once you file the appeal, and if you can work it out with the local assessor, everything's good, no harm, no foul. But where it gets tricky and where it gets real hairy is if you can't work it out and come to some kind of agreement, then you go to what's called a PITA-BOA. And this is these people are appointed and volunteer for this board that will oversee all these appeals and come up with a decision whether they agree with the taxpayer or agree with the assessor, right? So if they don't agree with the taxpayer, well, then you go up to the next level, which is Indiana Board of Tax Review. Okay, and these start getting to be real court and procedural, and where if you don't dot your I and you're not an attorney, you kind of get beat up pretty quick. Of course, the higher you go in the procedural portions of this, the harder it is, and the more money you're spending to save this money. So you see a lot of big commercial that are saving millions of dollars going up to these escalation here. But if you were going to save $500, how much time would you spend to try to go pay an attorney to come in to do a procedural thing? If anybody wants to, somebody pipe up on that one. You got a $250 an hour attorney going up into the IBTR. How many of you would want to do that? Crickets. Okay, I'll take that as no. Nobody would. Yeah, it gets pretty pricey and pretty expensive real soon. So you really want to try to work it out, and typically you can. Typically we can work out things in this level because from our perspective, we know what all the regs are. We know what all the things are. We know where they're going to go with it. So it's pretty simple for us to go, well, yeah, you're probably right on that, or no, you're not. And we point it out, and then they'll sway to our side on that thing. So here's kind of how the procedural appeal of the assessment go. Taxpayer has the right to appeal an assessment. Right. So remember, we appeal it because of the tax value being too high. So that's why we would do it. When you've got 45 days to get that done, typically, once the tax bill comes out, because that's when the general public generally knows when their new tax value is. As I've already told you, it's June 15th, the deadline. But the appeal gets filed, right? And that initiates a review. The request requires the assessing official to set a preliminary and formal meeting with the taxpayer, right? Or the tax rep in our case is what we go in. So we handle a bunch of these. So the assessment official holds that preliminary hearing in the meeting for the taxpayer. And we try to resolve as many issues as we can. If we can't, again, we go up to the next level. The next level then takes that 134 that we file, and I'll show you what that looks like. And it goes to the next level. If PETA-BOA can't agree, again, it goes up and up in the levels. And I won't bore you with all the details here. We've already kind of covered it, but this is the flow chart that the state gives out and kind of goes down into more details on the process. So, yep, we've already talked about the 45 days. These again, talking about initiates the review. So this, if you can see it, if you can see this right here, this is a short form. Marion County has a short form. There's a longer 4-page one for the state, but we file it with those. Those are called 130s. They must hold this preliminary hearing with us to go forward, and they do. It's not like they don't, and they won't. So they will. So then, if the informal meeting doesn't work, or if it does work, then we get a new. This was the tax values at the time we went in, and this would have been the tax values when we left. Okay, so we would take that 20 plus the 4 and have 24,000 times the 2% rather than the 45 plus the 4, right? So again, if they don't approve this, I know I'm sounding redundant, but just kind of going through the process again, and we'll get to some questions. If they don't approve it, then we're going to go up to the next stage. Here we are. Here we have to file another document to go up. Oh, I apologize. At PETA-BOA, if you don't make your appointment, the county can charge you $50. So if you did this on your own and you're going in there and you might be saving $10,000 or $15,000 or whatever, remember that's 2% of that, whatever that number is. If it's 20, it'd be $400. That you'd be saving if you win. So you don't want to miss those $50 penalty. So, and there is no appraisal required. However, you do have to prove what you think you have and why you think your values are the way they are. Because I can tell you this, the county will have all their evidence and you have to have it to beat them. Or to have them agree with you. So the IBTR, once it's not approved from PETA-BOA, you only have a certain number of days, 45 days, to refile another form with IBTR, and that form's a 131. It has to be done exactly right, or they will kick it out. They don't play. It's again, this is more procedural now. So those happen. They'll have a hearing within 9 months. So it's not real fast. None of this process is real fast, by the way, even after you file the appeals. And IBTR must have a decision after 90 days of having the hearing. So if you don't get an agreement at IBTR, you can file in 45 days up to the tax court. Okay, and it goes on and on and on for these processes. And trust me, unless you've got something really big, don't go there. Just run away, cut your losses, and go do something else. So that is all I've got for my presentation today. I will open it up for questions. So feel free to ask me any questions you have.
So if we just
Hey, Chair.
hired you to handle things, how's that work? What are your rates? What's the process, timing,
Right.
that kind of stuff?
Yeah. So people that hire us, you go to our website at appealtaxes-now.com, and you go up on the top and it says begin or order. and it will take you all the way through the steps. We've spent a ton of money in technology you'll log in, you'll find your properties. If you have 1 or 10 or whatever, they'll come up, you select those. Once you select those, it will automatically submit back to you all the paperwork that we have to have. And you'll get that signed. One of the documents gets notarized. Even with the state of Indiana, for us to represent you, you have to sign a POA that allows us to represent you in the limited use of the tax purposes, for the tax value purposes. So those come back, we file them all, and then they go in queue with the county. Once the county's ready for us, and we're down there all the time, we go in, we print out all the supporting documents, everything, and get everything finalized, and get you a result, whether that's a positive one or a negative one. I'm not telling you we always win, because we do not. However, we do have a very good record of winning, and we take them a lot of good evidence. Oh,
Okay, so we have 2 questions in the chat. The first one is, can you put your contact info on the screen?
yes,
And the
ma'am.
second is, do you typically see assessed values converged to purchase price, or are they pretty independent?
Yeah, so that's a great question, because you would think that the value of a property is what somebody's willing to pay for it, right? So in the assessment world, although sales price is a very good indication of what the value should be, they call that sales chasing when they do the mass appraisal. So they cannot go and take all the sales and just automatically make those what they sold. They throw them into the mix, and then they redo all their numbers, and it kind of starts flowing out. So you do not see that in the mass appraisal system, and you will not see that when your new tax value comes up to represent that. What was the other question?
What do you base your fees on?
Oh, yeah. So because we don't charge anything up front, we do everything based on if we're successful or not. So, it can take, in some cases, it's taken years, a year or two. When they were way backlogged, it would take a while, and they're catching up a lot more now. But we charge 50% of what we save, and we do give volume discounts for large packages and pools of that. But typically, everybody's just happy that at some point they get a check in the mail and says, "Hey, you got some money." They didn't have to do anything, and we did all of it, monitored it all, processed it all. So you just go right here where it says "Order Now" and go from there. Does anybody on here have ever? Do you all own your own personal property and a income property? Oh, well, hold on. We got a question here. Sorry. Successful appeal does not retroactive reimbursement. Oh, yeah. Good point. Let me address that. So you cannot go back back years prior to your assessment if, okay, your bill's coming out right now, right? And the deadline's June 15th. If you do not file an appeal, well, first of all, you should have something that's worth filing. You don't want to just file it if it's not worth filing. It's just a waste of time. However, if it's overvalued in the basis and you've noticed this, if you do not file your appeal on the time by the deadline, you lose all rights for that appeal in the past. So now you've just got to keep paying it, and you lose that money. It does not go toward your future assessments either. The state of Indiana does what's called reassessments. Every year they run their algorithm again, and it changes up the numbers. Every so often, I think it's I should know this, but I think it's every might be every 5 years. They do a whole reassessment, but they do a shorter version of it every year as it goes along. That was a good question, Teo. I will say this, since nobody's asked any other questions, I will say this. So as the values of properties are going up, the tax values are becoming tighter. The margins of error in there are, sorry, there's our phone number right there. The margins of error on the values that they're giving are less than they were in the past. Just because the values are going up so high, you don't want to file something that's already under assessed. You only want to file it if it's over assessed. So, but those margins still are out there. Just it just may not be as lucrative to file on everything all the time.
And we have a few more questions in the chat. One is, if I call the number on the website, will I reach you, or do you have somebody else answering the phones?
Yeah, we've got staff that answer the phone. They'll return your call in most cases. I mean, if there's something specific you need to talk to me about, then they'll get me a message. Typically, they can handle all the incoming side of things. Occasionally, there's something that's a little bit odd or different that's requires one of the assessors, but typically they can manage everything for you and help you get through all the process. And you would see Kristen at some of the meetings anyways. We do have a booth, so she's usually there. Been a little more sporadic since the COVID, but yeah.
And another question. So I just go online and fill out the request form to get the process started?
Yeah, it should be very simple. And once you do that, you'll get an email right back with all the documents that we need back from you, already ready to go. You just gotta sign them and send them back. And we'll take care of everything else from there. All you got to do is that initial information. We may ask you a couple of questions about your property, but other than that, you'll be fine. If we start the process. So hold on, let's go back to this one here. Tio, if we start the process, will your team provide guidance whether or not my assessed value is actually already overvalued? So when you start the process, our system, if it's way out of line, where it's fine on a single family, mind you, single family, we'll suggest we don't even file it. And we won't file it. So you won't even have to worry about that. We'll take care of everything. All you got to do is give us the address and your information, and we'll make sure what should be filed gets filed, what doesn't on that. The next question, we have a 450,000 square foot warehouse. We need to appeal. I'd prefer to talk to you first though. Okay, yeah. So John, on the commercial ones, yeah, you can give me a call, shoot me an email. My email is, well, you can send it to appeals at Appeal Taxes Now, or you can put it to Jeremy Miller at Appeal Taxes Now. What I will do for you, John, is I handle predominantly all of the residential, and we've got another guy in our office that handles most of the commercial. So your commercial questions might be more specifically answered by him, and I'll get you in touch with him. So this question here, what is the average percent of assessed value of reduced in values? I tell you what, we used to have a counter of all the amounts that we've saved, and it was a ton. Those margins are getting shorter and smaller. As I told you, as the values have gone up, you guys have noticed that it's hard to find a good deal now. It's, the values, people are having bidding wars. So those as that happens, the margins get smaller and smaller. Okay. So to give that on an average basis over the years is, it's a difficult thing to do. Just know that once we get them, we'll evaluate them with our system. I've spent a crap load of money on an AVM system. We value everything with our system. We get it all done. We get the paperwork. So we'll go through that and let you know at the end, and you don't have to worry about anything. We do statewide on the counties. That's correct, Randy. I will tell you that even though we do statewide and we represent, like I said, we've got America's Home for Rent. They got, in many, many counties and several other large investors. But the margins are greatest in the Marion County than they are in the other counties. I'll just share that with you. So some counties are smaller and they are able to get their values tighter into line. Doesn't mean that there's not opportunity to save. I'm just sharing with you that it's not as many. Well, if there's no more questions, I can give you back about 20 minutes of your day. Hopefully you found this interesting and informative, and I appreciate you letting me present to you.